Okay, how about now? Can you hear me now? Can you hear me now? All right. Well, hey, we got a big group tonight. Okay, awesome. Well, it's just going to be the three of us. We'll have a good time. How about that? Sorry about all that audio mix-up problem there at the first, and hopefully those people that are trying to watch this on a recorded fashion don't get drugged down. But let's go ahead and get started, and I will begin to share my screen. Give me just a second. Okay. All right, let's get this going. Everybody sees the PowerPoint, I hope. If you can't, let me know. All right, thank you. Hi, Christine. All right, so we're going to talk about risk and rates of return, and you would think that that sounds like a pretty academic subject, and the way we're going to treat it for the book and for what you need to know at this level, it really is pretty academic. However, it's a real word, and it's a real word that we really use on a regular basis in business, particularly where we are. Risk is, what's the risk you're going to lose your customer? What's a risk that you're going to have a major accident where people get hurt? But what's the risk that you might have a material misstatement to your financial statements? What's the risk of a cyber attack? There's all kinds of risks out there that we're constantly trying to assess. That's not what we're going to be talking about here. We're going to be talking about the risk of investing in a variety of things, and how do you deal with that risk? What's an appropriate level of risk, etc. So while risk is a really hot topic and one that's really literally spoken about in boardrooms, we're really going to be talking to it as it relates to investment theory around stocks, bonds, interest rates, those kinds of things. So you've always heard no risk, no reward, right? And that's true. So if you take a higher risk, you will be afforded the opportunity to have a higher reward. It's not certain. If you take a much lower risk, you're going to get a much lower return, right? And unless something is abnormal in what you've done, where you're able to take a very low risk investment in Walmart and somehow they take over Amazon and the stock goes up 500 times. That'd be fairly low risk, high reward, but that's not normal, right? No pain, no gain. Don't put all your eggs in one basket, or put all your eggs in one basket but watch that basket, right? So what is it? What's the right amount of risk that you would take with your money? And let's just assume you've been working and saving and chipping away and trying to build up a little nest egg. How much risk do you take with that? Are you willing to only buy CDs to make sure that there's no way that you can lose money? Or are you willing to take a little risk and put some of it to work in the stock market to see if you can get a return higher than that, so that you can make a little money off of the money you've already earned? What's the right amount of risk? And it's the same for professional investors as well. As what is the right amount of risk? How do I reduce the amount of risk I'm taking for my investments? How in the world do I deal with things? So let's talk about this. There are really some different types of investment risk. So when you're investing in business, you've got the standalone risk, which is, hey, I invest in Dasky Inc., the company I work for. So what happens to that one stock? What if you only bought that one stock? Everything is dependent upon that one stock. So, however, if you have a portfolio, let's say, let's put it in a different way. Let's say you're a lender at the local bank. Do you lend everything the bank has to one customer, or you lend it to 1,000 customers? Because if that one customer does great, then you do great. But if that one customer goes down, you go down. If you spread it out and you have 1,000 customers, and 995 of them do well and 5 of them do poorly, you're still probably in good shape. But you have diversified out your risk. So what is it across the portfolio of investments, whether it's loans you've made or investments you've made in bonds or stocks or whatever. But really, 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 the investment risk is related to the probability of getting not much return, or actually losing money, or frankly losing it all. So what's the probability? Now, I know nobody can tell you what the really true probability is because no one really knows, but the idea is to try to figure out what you think the actual probability of earning a negative return could be. Right? And so that would affect how much you would invest in a particular loan. If you thought you weren't going to be paid back in your loan that you made from the bank you work for, you might not make that loan. Right? So if the chances that you aren't going to get what you think you're going to get, or even negative what you think you're going to, negative to what you're putting out, that's the riskier the investment. It seems kind of simple, but that's really what we are. Then there's some probability distributions. So if you list all the possible incomes, possible outcomes, and the probability of each one of those happening, you can show it graphically. So if you said right here is a 0 return on your investment, but you think that you're going to get 15% return. That's your expected rate of return on both firm X and firm Y. Well, it would be the same investment, right? No, because the probability shown here on how probable is any one of these particular outcomes is different for each one, even though the expected rate of return is 15%. So you can see that in firm Y, there's a much greater chance of you losing almost all your money and a much greater chance of you making a whole lot of money, where firm X is a much greater chance of you making exactly what you're thinking you're going to make, but a much tighter distribution of the other possible outcomes, from losing some of your money to making a whole lot of money. So which one's the best investment? Well, I don't know. It really depends upon your appetite, your desire, your interest in making these kinds of investments, right? So what's your appetite, once again, has a lot to do with it. But we're trying to determine what you think the range of probable or possible distributions of this return could be. So the question is firm Y a better investment? Is firm X a better investment? Or the two of them together a better investment? So let's talk about some other things that happened in the world out here. This is some real returns from 1926 to 2009. And there are, if you looked at this and you said small company stocks, large company stocks, you know, so small company stocks, they typically make more than big company stocks. Yeah, there's less investment in it. They're long-term corporate bonds, which we've talked about. Long-term corporate bonds, long-term government bonds, and short-term government borrowing, which is shown in Treasury bills. Now, each one of those has a stacked return. So you would see that the small company stocks making almost 17%, the large company stocks making almost 12%. You would think, well, I just put all my money there, right? So why would I invest in anything else? Well, because in this case, the standard deviation, or the amount that you're likely to deviate from your expected average return of 17%, is pretty wide. So you could, in any particular moment in time when you need to get in or out of a position, you could be up, 33% or down 33%. And that's the first standard deviation, right? And so on large company stocks, once again, well, maybe I don't want to take that much risk, so let's look at that 12% return. Well, that's still a 20% standard deviation away from what I think. So that's a pretty wide swing. Now it begins to tighten down the more you go along. So once again, the more you risk, the higher the reward. The lower the risk, the lower the reward, right? And these are real numbers over a long period of time, so it's pretty standard way of looking at the world. And this is the kind of view that finance people view the world of investment risk in. Once again, smaller companies, higher return, but higher chance that you don't make any money at all. Large companies, pretty good return, but pretty good chance you lose some money, as well as make some money. And then further down the food chain, the more secure the investment is, the less you're likely to get paid on it. And if you just think about it from your own appetite, you know, if you felt absolutely certain you could make $1 today, would you prefer that over the chance to make $2 next week with the chance that you might get $2 or zero? Which one would you rather have, $1 today or next week with $2 or zero? It's kind of what we're talking about. And that's why these pricings are different based upon the expected outcomes. So here's some hypothetical investment alternatives, and we're talking about an economic condition of a recession, below average economy, an average economy, above average economy, or a boom economy. In this column, we're talking about what's the probability that one of those things would occur. There's 10% chance of a recession, 20% chance of it being below average, 40% chance of it being average because it's average, 20% above, and 10% above. So very even a dispersion of the probabilities. And these are different types of investments that you could make, right? So we're going to say a T-bill. So what could you make on a T-bill regardless of the economic conditions, because you have invested in T-bills and it has a stated rate, and that's what you're going to make on your yield to maturity, right? So that's what you're going to make. The next one, the HT, stands for high tech. So once again, high tech can have some extremely high returns, particularly in a boom economy, but in a recessionary environment, they're likely to not do well at all because no one's making capital investments. No one's making investments in a recession. Everybody's hoarding their cash, protecting their positions. And so the high-tech company is likely to get punished in a recessionary environment when in a boom economy they would outperform. Absolute converse to that, or contra to that, would be a collections agency. Collections agencies make their money when they go collect people who don't pay their bills, right? Who don't collect from people who don't pay their bills. And so in this case, they would do really well in a recessionary environment, because when things are in a recessionary environment, people have a tough time, they can't pay the bills, so a collection agency could do quite well. Where in a boom economy, when everything's doing great and everybody's rolling in the dough, they might not perform as well because there's not very much need for their services. And then we have U.S. Rubber as an example of an industrial producer that might have some varied dispersions based upon what happens. And this is MP, just is really kind of relates to a market performance. So what would happen, you know, in a kind of an average economy, they might make 10%. In a recession, they might lose 70%. But a boom, they might make 38%. So these are just kind of hypothetical investment alternatives for these different positions that you could have. Now, one thing we did not apply was this probability here, but you'll see later in the talk why that matters, and that goes back to you trying to determine how likely you think any of those particular outcomes you would be for. You're trying to calculate what you think the probability of you actually getting the return you expect to get. So why would the T-bill return independent of the economy? And do T-bills actually promise a true risk-free return? Well, you bought a T-bill with a stated rate on it, so whatever you paid for it and whatever rate you're going to get is what you're going to get paid. Now, in reality, as we've said 2 or 3 times, we'll probably say it 2 or 3 times again before the course is over, T-bills are really not risk-free, right? They are just as close as we can get to risk-free in the real world, and so we use them in the risk-free sense, in the default sense of the word, which means that there's almost no chance that the U.S. government would default and just not pay. They would just raise our taxes to pay for it, or print money. They do have a little bit of risk in that, since they're short term, when they mature, you know, what you do with the money you've got, you have to reinvest it again. But as we talked about reinvestment risk a couple of weeks ago. So now, once again, we talked about the high-tech and the collections as related to the moves of the market. High-tech moves with the economy. If it's up, high-tech is up. If it's down, high-tech is down. That's very typical. Collections, counter-cyclical. If the economy's up, then collections are down. Wherever if the economy is down, collections are up, and that is unusual, even though it does occur. So let's talk about some expected returns. So high-tech has the highest expected return. Market is about 10%. U.S. rubber's a little beneath it. You know what you're getting with T-bills. And collections is only 1% expected return based upon the distribution of the outcomes. So high-tech would be what you should invest in, right? It's the best alternative, really. Well, what about the risk? Is it riskier than collections? Is it riskier than T-bills? So, and what's the right reward for the riskiness you take? I can't tell you. There's no hard and fast rule. You can't look it up in a textbook. It's market driven. It's appetite driven. It's individual investor driven, and sometimes it's regulatory driven as to what you can do. But if you just said here is the probability that you're going to get paid, right? A T-bill, we're kind of saying it's infinite. Yes, there's almost 100% probability that you will get paid 100% on the contractual obligations in a T-bill. However, U.S. rubber, you think you're going to make about 10%, but there is some dispersion of what you think you could make. But in high tech, you can make 12.5. You might really smoke it out here, but you might really lose a whole lot too. All right, so there are some differences in these standard deviations between a kind of a traditional gray industry manufacturing company, distributor, and a high-tech company. So once again, you would say, if you're comparing risk and return, kind of the inverse of what we talked about before, the expected return of a T-bill is 5.5%, zero risk. High-tech, you can make a lot, but you got a 20% risk. Collections 1%, but you got a 13% risk. Seems out of place, doesn't it? U.S. rubber has a 9% return, but a 20% risk. That seems out of place. But the market, 10%, 15% risk. That seems about right. So, you know, really those kinds of things. You know, once again, they're market different. They change all the time. If we were using today's data of the last month, you would have a completely different set of data here. So the standard deviation, and I've mentioned it before, and I'm sure everybody's had stat by now, but it's just basically measures the riskiness of a single investment and how likely it is that you will or will not achieve that. And so the lower the probability that you will get the expected returns, the wider it is, and vice versa. Pretty standard. There's a thing out here called the coefficient of variation, and it's a standard measure to determine how widely dispersed the expected values would be that would show the risk per unit of return. It's pretty interesting. Since it's such a simple calculation, you might see that on the quiz, but it's also not a huge point of emphasis for me at this level of the course. And certainly something that you would be looking at later on in your course work as you go through your BBA. But the coefficient of variation is something that we actually think about and talk about, particularly if you're on the buy side, which means you're the one that's actually making the investments. All right, so a couple of other things you've got to think about, and I talk about attitudes or appetites, or what are investor appetites, and these are maybe seem kind of overkill to point them out here, but there is a basic fundamental principle of investing in human nature that if at all possible, investors dislike risk. You'd rather have a safer investment if you could. So if you are going to make a riskier investment, then somebody's going to have to be willing to pay you more to take the risk. And so this idea of risk aversion, risk containment, risk management is key to the understanding of the philosophy of investor attitude towards risk. What that means is that the difference between a risky investment and something with no risk, like a T-bill, will be different. And it's a method to compensate the investors, the lenders, the whatever, to take more risk. Look, we've got a great company here where I work, and we we're very credit worthy in our minds, but we're not the same credit worthiness of Texas Instruments. So if someone was going to lend to me or Texas Instruments, it would probably be two different rates and two different sets of contractual obligations, right, because of the risk difference. And so people expect to make more for the riskier the investment. So you want to, as you begin to build a portfolio of investments, typically if you are investing, you're not going to invest in one stock. And as we talked about earlier in the course, are these people that do mutual funds. So you just put your money into the mutual fund and they select a portfolio of stocks for you to invest in that are appropriate for your investment appetite. So I don't know if any of you have a 401k, but if you have a 401k, it might say the 2020 fund or the 2030 fund or the 2040 fund, and what they're saying is that when do you think you're going to want to consume the money? So you put it in that, and it's got a portfolio of investments that are appropriate for somebody who has an investment horizon between 2017 and 2040. And they would select a portfolio of stocks. Well, if you're selecting your portfolio of stocks, how do you go about it to try and diminish the amount of risk that you want to take? Because remember, investors are risk averse. They'd rather make more money with less risk. Duh. So the notion really here is a portfolio's return expected return is the weighted average of the components of the portfolio. So let me show you what that looks like. And it goes back to this thing when I was talking about this probability chart that I talked about before. So 10% chance of recession, 20% chance of below average economy, 40% chance, 20%, 10%. Same dispersion. So if you had a portfolio evenly weighted of a high-tech company and a collections company, contracyclical, in the recession environment, these two would completely weigh each other out. So at a 10% probability, you'd get zero. This kind of reminds me when I go back to my weighted average cost of capital, the way I laid it out in Excel, same kind of a thinking. So you've got the correlation between -7 and a -13 is there's your 6 times 20%, it gets you their 3 portfolio weighting. So you weighted average this portfolio to see that your expected return for this portfolio on a weighted basis is a 6.7. You see how we got to that? All right. So no, we don't need this one. So the standard deviation of 34% for an average stock, and there is a basic notion in investing that most stocks are positively correlated with the market. So if the market goes up, the stock goes up. If the stock market goes down, that an individual stock will go down. Even in certain verticals. So if you were in fast food, if you were selling Whataburgers, and the fast food expectations for the fast food market in general go up, your stock would generally go up. If the expectations for the fast food market in general go down, you would go down too. So there is this correlation. Now, they're not directly or perfectly correlated, and we're going to talk about this in a minute. It's one of my favorite things to think about, is if the stock market moves up 10%, how much does an individual stock move, since it's not one-to-one? If it was one-to-one and the stock market went up 10%, your stock would go up 10%. So one way to reduce the risk is to combine a bunch of different stocks into one portfolio, and it lowers the overall risk. I have a few charts in here. You know, two perfectly positively correlated stocks, so you know they both go up. The portfolio goes up with the market. This one is if they're negative. If they're perfectly negative, you still kind of end up at zero. But I think the point here is if there's a partial correlation, which is much more realistic, and you have, you know, one stock going one way, one stock doing a little bit differently, but you can see they're generally positively correlated to each other. This is what your outcomes would be if you held them separately, but holding them together, you have a much higher probability of getting your expected or required rate of return. It may not be intuitive, but it's basic, simple math. Another way of looking at it is if you said this is the number of stocks held, right? And what is your riskiness of your portfolio? The more stocks you hold, the less risky it gets. So there's some curves out there, and once again, this changes all the time. This is just an illustration of a certain point in time, but if you get 2,000 stocks in the portfolio, you have diversified away a great deal of the risk. Now, have you diversified all of the risk if you do that? Well, no. The whole market could go up. The whole market could go down. The whole world could go into a global recession. Who knows? But you have done what you can to diversify away the risks by simply owning a bunch of different stuff, because any one thing can't go down. Now, you could have a very tech-heavy portfolio and just own nothing but technology. And as I know, this happened to someone I know. They were in 100% tech stocks, and 2001, when the dot bomb happened and the bottom fell out of all technology stocks, and they lost almost everything they had, because while they were diversified, the portfolio on a wide number of stocks, they were all in technology. They weren't some in technology, some in automotive, some in industrial, some in retail, some in restaurants, some in international. They did not really truly diversify their portfolio. So there are really the risk here is both the market risk and the diversifiable risk. Now, the market risk is it's the portion of that stock's riskiness that you just can't eliminate by diversifying away, because that individual stock has its own inherent risk. But you can diversify away the overall effect of the riskiness of a stock by combining it with a great deal, a number of others, as we've demonstrated in the chart above. So what happens if you don't diversify? If you think, hey, I'm going to put all my eggs in one basket and I'm going to watch that basket, will you typically be compensated for that extra risk? The answer is no. You know, it's standalone risk, so if you continue to diversify, the rational, risk-averse investors are concerned with, you know, what is the risk in addition to the market risk or my stock. So there's only one price for a given security. So if you don't diversify, the price doesn't change. It's just the price. So typically, unless you are just absolutely the most brilliant stock picker on the planet, no compensation would be earned for holding unnecessary risk that you could have diversified away from. Hey, Christy, that's okay. I've had that happen to me before in the middle of trying to teach, keep losing connection. So just keep coming in as you can. Or if, hey, by the way, Christy, if this is annoying you, you can just drop and then come back and watch it in one time when you've got a better connection. Anyway, a couple of other things you need to know out there. There's this really cool thing out there. I'm not going to ask you to know how to calculate it, but I do want you to know that it exists. And it's called the capital asset pricing model. And what it does is it just helps you determine what the right amount of risk return profile is. It's very, very important. I think Roy Kim referred to it last week in his discussion about bonds. So, but the conclusion of trying to figure out what's happening with the CAPM is the riskiness of a stock is its contribution to the overall riskiness of a well-diversified portfolio. Beta. As I said before, we had, talking about risk, I love this notion of beta. It's a really cool thing. Now there's a beta to the market, there's a beta to your industry sector. But what that really means is, earlier we said that most stocks are positively correlated to the market. So that if the market goes up, the stock goes up, but if the market goes down, the stock goes down. So it's positively correlated, it's correlated to the movement of the market. But what beta tells you is, if the stock market went up 10%, does this stock go up 80%? And if it goes down 10%, does it go down 8%? Right? So how much does it move? And so a 1 beta means that if the stock market goes up 5%, your stock goes up 5%. Now, if the stock market goes up 5% and your stock only goes up 4%, that's a 0.8 beta. And what it does, all this really does is tell you how risky a stock is compared to the market, based upon historical performance. It's typically a very good predictor of the future, but once again, as in any accounting or historical look at the world, it is not a predictor of the future. It's just a pretty good indicator of what we think the future could hold. So beta is a calculation that can be done, that every stock out there has a beta. If you think back to when we went out to Yahoo Finance and we started looking at those stock portfolios and looking up the stocks, they all had a thing in there that said what the beta of that stock was. That's how fundamental this notion is. Beta is a big deal. So it's one of those things that professional investors, when they look at an individual stock, really want to know. So what else we want to know? Beta is 1 if it's just exactly as risky as the average stock. If it's greater than 1, it's riskier than average. If the beta is less than 1, it's less risky than average. So if you could think of course, in our area, it's not a really good correlation, but to think of something that just seems like it has almost no risk, like a utility provider, right? Well, we had a bankruptcy in that here, but still, it seemed like that should be like no risk at all, right? And so you would expect a very low beta there. And however, if something is, all we do is sell super high-end luxury RVs, you would expect it to have a higher beta, because those would do really well in an up market, but in a down market, they would really kind of stink it up, right? So most stocks have betas in the range of a 0.5 to 1.5. So anything outside of that is kind of outside of the norm. But beta is really just how does an individual stock act in correlation to the overall market. And yes, there are up betas and down betas, which means many companies, if you think back to that chart we had up earlier where U.S. rubber in certain economies, it performed differently and it seemed kind of out of place. Well, once again, if you have a stock that if the stock market goes up 5%, your stock may go up 4%, but if the stock market goes down 8%, your stock might only go down 2%. So there's a difference typically between the stock market moving up and the stock market moving down that would give you a different calculation of beta. Now, can the beta of a security be negative? Well, sure. The negative beta in our case would be the collections company that we talk to. So if the stock market goes up, it goes down. So look, it's unlikely, it's not ever going to happen, but theoretically it's out there. So, betas, well-diversified investors, which are considered appropriate investors in the academic sense of the world, are expected, they want to know how it's going to move, that stock's going to move in relation to the market. So since you can't really use it as a true predictor, it's based entirely on historical data, but it's a pretty good measure, pretty good sense, give you a pretty good feel for what you would expect to happen to this stock in a variety of conditions. And if you think back to the different investment criteria when I talked about payback as a measure of whether to make an investment or not, Beta is another one of those tools. It's really simple, it's easy to understand, and it may not be perfect, but it certainly has a very effective way of communicating the concept very simply as to how risky a particular stock is. So if you wanted to calculate the beta, if you said here's the market return, here's the return of the investment, right? Return investment, return of the market. So you would say, if you were plotting it out here, you would say, hey, for a 15% market return, I would expect a 17% return on this stock. So that's, you can plot it out if you really want to. Another way to look at it is what's the beta for, here's what a high-tech line would look like that we talked about. The contracyclical collections line would look like this, and then it's just a flat line for the zero risk T-bill. Another way to look at it is, once again, comparing these different types of potential investments, where the high-tech, would get you this 12.5% return, but it has a higher beta. The market is the market, so you get a 10.5% return on the market, but the market's the market, so it's a 1 beta. Once again, U.S. rubber, higher return, but a little less risky because it's a very traditional, standard, producer. T-bills, there is no beta, and collection is negative. But so riskier securities have higher returns. So this is the way that you would begin to look at those things. You don't need to know that. And what's the market risk premium? Well, if you invested in CDs at the bank, or you invested in Shifting Sands Mutual Insurance Company, you would expect a different return. And so all this is saying is that you have a standard risk-free return that they put a market risk premium on top of. So if you were going to try and calculate required rates of return, you would say, let's just say, this is what it would look like at high tech, based upon, here's the risk-free rate, here's the risk premium times the beta. You would want to figure out, that would tell you the required return you would want for making that high-tech investment. Does that make sense? 5.5% risk-free rate plus a risk premium times a beta equals what you would think the correct return would be. And this all ties back to these same numbers up here, right? Same for a collection agency. 5.5% risk-free return, 5% premium for investing in this crazy investment, but a negative beta, give you a different expected return. And if you had an expected return versus the required return, if it was greater than that, you would buy it, because you would say it was undervalued. You were getting a good deal. It was cheap. If it's overvalued, you wouldn't buy it. If it's overvalued, you wouldn't buy it. If it's fairly valued, you probably wouldn't. Maybe you would buy it, but really what you're looking for is undervalued. Right? Trying to make money. And by the way, I don't know how I'm telling you this, but in the investing world, beta is movement in conjunction with or in synchronicity with the market. There is another thing out there called alphas, and that means is, how do I do better than the market? How do I consistently produce better returns than the market? How do I get alpha, not beta? All right, and then just a little bit on the cap that you don't really need to know. Okay, that's really it for tonight, folks. Pretty simple. And do we have any questions? All right. Well, thank you for showing up. If you have any questions or anything, send us an email. And thanks for everything. Talk to you soon.